Hello, my name is Dan Burns. I'm a senior portfolio manager at AAM. I've been here for 18 years and spent some time in accounting at CNA Insurance before that. Of my 18 years at AAM, I've spent the last 15 working with risk pools and am today the firm's leading portfolio manager for our risk pool relationships. I have some friends joining me today. I'll allow them to introduce ourselves. Andrea, go ahead.
Hi, I'm Andrea Thiemann. I am out in Lincoln, Nebraska, work with the Nebraska Risk Management Association, and we work with counties and county-related entities, agencies. I've been in the position for about 25 years, which is hard to believe, and I'm the controller and HR manager for the organization.
Bob?
Yeah, Bob Tinku. I'm with the Park District Risk Management Agency, which we will identify as PDERMA going forward. I'm the Director of Finance. I've been here about 4 years after a career in the commercial industry as a CFO at a couple different property casualty carriers. And our pools are entirely made up of park districts in mostly northern Illinois. We get down about as far as the middle of the state, but that is the sole clientele are just park districts within Illinois.
Great. Well, thanks to you both for joining us today. What we wanted to talk about today, Andrea, Bob, and I, are some of the challenges facing risk pools. At this point, there are several. And so with that, maybe we'll jump in. I'll ask Andrea and Bob to address a few of the challenges we see. And then towards the end of this, we'll talk a little bit more about the investment environment, which has proven has become challenging as well for pools and all investors. So with that as an introduction, Bob, Andrea, anytime I hear anything from AGRIP or other risk pools, one of the first topics that comes up is reinsurance and what's happening in the reinsurance market now and the challenges that's posing for risk pools. I wonder if you guys could spend a few minutes talking about maybe particularly what you're seeing on your end and how that's become a challenge for your pools. Bob, do you want to lead us off on that?
Sure. I mean, clearly, it's a hardening reinsurance market, and when we're finding a number of challenges in that arena. The biggest impact to us so far this year has been the infectious disease coverage, obviously because of the COVID pandemic. That's a coverage most of our members need because they run swimming pools and restaurants at their facilities, and therefore have certain types of bacterial outbreaks and things that they need coverage for. Yet everything's kind of getting swept into this whole infectious disease coverage. And if you've seen the financial results out of Lloyd's, et cetera, this year, most of them lost a ton of money last year on this coverage and are not even offering it all. So we're now having to self-insure that coverage for our members because it's something they do need, but we're not able to acquire. On the other side, we're just seeing, the results of bad property coverage market, due to all the hurricanes and wildfires and the rest of the USA this year has really impacted our property coverage substantially. So even though we're in Illinois and have had good loss ratios and not been impacted by that, the carriers don't have as much capital. So we're seeing 35% increases in Illinois, which I know is pretty light compared to some of our friends in Florida and North Carolina and places like that, but nonetheless is a big challenge for us. And then the other big problem for us has been liability, which is one of the real reasons PDERMA was formed in the first place. A number of carriers will jump in and out of our space just due to the unusual risks. Like I said, we're operating swimming pools, parks, things where people tend to get hurt and offer a lot of lawsuits, and the coverage can swing pretty wildly there. And this year, fortunately, we've been able to retain coverage, but we've had to do a lot of it through one of our captives and pick up more layers there because the coverage is just not available as carriers are looking at governmental entities and saying especially when you consider, the riots and, other problems that occurred last year, we're not really sure that we want to be too involved in governmental entities right now.
That's interesting. Andrea, how about on your end in Nebraska? What are some of the things you've seen?
Well, I'm really thankful we don't have infectious disease as one of our coverages, because I can't imagine how challenging that must have been this year. Property market, we're seeing a hardening there for sure. We live in a hail belt in our state, so we've had some significant storms over the last several years, and they do seem to be increasing in frequency and as well as severity. Cyber liability has been a challenge for us this year. In fact, we had a very late quote come in on one of our programs, and we had budgeted, I want to say, a 25 or 30% increase, and it came in at almost double what we thought it was going to be. So we're seeing some challenges there. We didn't talk about this yet. I don't know if you want to talk about interest rates, or if that's going to come at a later question.
Why don't we come to that one a little bit later, because there'll be
Okay.
a few extra things to talk on that, but that's certainly, interest rates certainly a challenge. But all of those things that you just talked about all seem to be what I would call a use of your capital, whether you want it to be or not. You've had to use capital for cyber or property or infectious disease to support your members. How do you combat that? I mean, what are there things you can do or you've been thinking about in advance of this, whether it be retention, something along those lines to help combat that? Or is there anything you can do on that side of the equation?
Yeah, I'll take it first. We're certainly looking at increasing our retentions. Unfortunately, we've built up a solid financial footing over the last 8 to 10 years, where we're able to look at expanding some of that self-insurance effectively by raising our retentions to help combat some of the costs. And also, as things get more expensive, the value of that reinsurance becomes less. So retaining more of it for yourself makes sense. We've even started investigating setting up our own captive to move some coverages in, because we've got different members that might want different levels of retentions, and that's one way to help shelter a large group like that, is to put some of the risk into a different captive. We haven't actually moved in that area. We're just looking at it, but that's what happens when markets get hard and prices start going up. You start looking at all these different alternatives. And like the third thing is, we currently have we're a member of a captive with other governmental entities. And that's been a big help, because you get a little more flexibility on price and retention with something where you're a co-participant and risk taker, as opposed to going to the commercial market.
Andrew, anything to add on that front?
Yeah, no, we've also looked at increasing retention levels. Of course, like our 3 largest pieces are losses, reinsurance costs, and our administrative budget. So we look at we've expanded our loss prevention program over the years to try to be more effective in that area. And then we always are evaluating our budget and trying to keep it just as lean as it can be, particularly in times of a hard market like we're seeing right now.
Yeah, that seems to echo what, as we talked to other clients as well, some of those same ideas. I know that the idea of forming a captive seems to be getting more and more traction around pools around the country. Shifting gears a bit, another topic that I know it's at least come up at AGRIP, for example, has been succession planning. Any thoughts around that front, maybe Andrea, from your end on, do you see that as a challenge? Is it something that you're thinking about at NERMA?
Absolutely. Our pool was founded in 1988, and I would say, our program, many of the staff have been here since the early to mid 90s, and we are having a kind of a bubble that has come up where we're going to be replacing probably between 3 and 6 people here in the next 5 years, I would say, and that's very significant. We typically have very low turnover.
Have you seen that at Epiderm at all, or not? Is that not as quite as acute for you?
Yeah, no, we're in a very similar situation as NERMA, where a lot of our key management, especially the people that have been there since nearly the founding of Epiderma, are getting close to that time. We're looking at 5 or 6 year horizon as well. But I think that's something at least you have enough time to start planning for and considering. But of course, it's a big risk and big consideration. I think a bigger one for us is really more the succession planning of our members in terms of its impact on Paderma. That a lot of the members are in the same boat as us, and when these members help form Paderma, and they're part of that pool and understand the value of the pool and the reason they formed the pool back in the hard markets in the late 80s, early 90s. And now you may have a lot of new leaders coming in who haven't had that experience and wonder, why are we in this pool? Hey, I just found a 5% or 10% discount to this other carrier. Should we be picking up this coverage? And it's really trying to show them the value that we represent to their organization, and that becomes a little bit harder to do when you haven't had, fortunately, some of the things we're going through now, that does give us that opportunity to show them the value we present for the newer members, that haven't been in the same leadership position for as long.
And that's an interesting point to have the last year or so in this coming period as a proof statement, if you will. Maybe it would be beneficial instead of always having to point to a market in the 90s and 20 years ago. That might not be quite as relatable for folks who are coming into those positions. That's an interesting thought. The other thought that strikes me is you have the succession planning. Some of the decisions that you are making today, and pools in general are making today, are being made by people who might not be there to see the final outcome of what you decide to do today. And that transition as well could be tricky and introduce some challenges, I would imagine. As you pass off, again, those decisions being made today into a future generation of leaders. So that, Andrew, you'd mentioned it before, brings us to the other challenge, and one that is a little near and dear to my heart, the low level of interest rates. So at that point, I'm going to try and share a screen here and see if that works. But it is certainly fair to say that investment income is being negatively impacted by the level of interest rates that we've seen. If you go back to where we were a year ago or so, the outlook for investment results in 2020 was pretty bleak. But as the year wore on, and certainly into this year, results have been probably better than certainly I would have expected in April, May of last year. And a big part of that is particularly for risk pools, which have a big bond portfolio. A big part of that is the rebound in bond valuations we saw, or the increase in bond valuations. That increase, of course, is a direct correlation to falling interest rates and falling yields we saw last year. Just for reference, this graph shows 2-year treasury yields, 10-year treasury yields, and 30-year yields. The longer areas of the yield curve, 30 years or so, have largely rebounded, but the 10-year area is still relatively low. And if you're investing shorter or intermediate securities, those interest rates, the 2-year treasury remains pinned near zero, and likely will be for a while. That is a challenging environment to try and earn anything with your next dollar of fixed income investment. And as you both sit there and think about your pools, maybe Andrew, you want to go first. Have you started to see low interest rates work their way into the financials or your financial picture at NERMA?
Absolutely. In fact, we just received our quarterly reports back from the Department of Insurance, so it was very easy for me to look up interest earned for the first 9 months of this year compared to last year's interest rates or interest earned. And we're down about 40% between the two programs from where we would have been at an annualized rate last year. So that's pretty significant.
Oh, that's very significant.
Yeah.
Bob, have you started to see that flow through on the Paderma side as well? So maybe not the same numbers, but the impact?
Yeah, the impact hasn't been as great yet. We have close to a 4-year duration. So as the rates started dropping last year, we've probably only lost about a quarter of our portfolio to those rates. But you can certainly see, as you're forecasting out, the long-term impact. And that's certainly, as Andrea was saying earlier, when you have rising reinsurance costs, one of the ways we try to offset that is, with investment income and reducing our overhead expenses. And when you have reinsurance rates rising 20 and 35%, and then your investment income's dropping too. I mean, there's just not a lot of overhead expenses you can gnaw at that are going to offset those. So, so that's probably providing us the big challenge in that we're not able to, mitigate some of the reinsurance increases with investment income increases. It's declining, which, and the other half of that is it wouldn't be as bad if there was, if we saw a similar decrease in inflation. But as you know, inflation's all relative, and a lot of the areas we cover, such as property, you're seeing lumber prices and wages for contractors, going sky high right now. We cover workers' compensation and health insurance. Medical inflation has not dropped at all. So we're seeing, significant increases in a lot of the costs that we cover, but yet we're not getting the corresponding, inflation in our portfolio.
That's an interesting point talking about inflation, because really, in the investment portfolio, you can see this big jump in yields we've seen so far this year, kind of longer maturities. A lot of that due to inflation concerns going forward. And so the market value of those bonds is falling as these interest rates and inflation concerns, interest rates rise and inflation concerns take hold. So, and today it's almost a bit of a double whammy. It is kind of nice, these higher rates for that next dollar you invest. But as you see that inflation, lumber prices, for example, on the property side, it's certainly not doing you any favors today anyway on the fixed income side of the world. It's an interesting point. It was back in the winter, actually, Andrea gave me a call and said, how could we be thinking about ways to combat this low rate environment and to start to earn something more, particularly with the next dollar we're going to invest in the portfolio. We can either invest it in fixed income earning hardly anything at all, but NERMA's got a strong financial position. Should we think about expanding our asset allocation or reviewing it anyway? And I think that it was a great call for Andrew to make, and it's a really good time, we think, to start thinking about asset allocation, and it's something we're working on with a number of our clients today. And the idea is to kind of take a fresh look, given all the pressures that we've talked about facing pools, to take a look and make sure you're maximizing the value you can out of your investment portfolio within a risk framework that's appropriate. So you're not taking too much risk, but that becomes a little challenging, I think, often for people to consider is how much risk should we take? The way we think about risk is dollars of surplus or net position that you're risking in a year where you have a bad investment market. We use a 1 in 200 year scenario as kind of our baseline. And so we actually just went through this process with Andrea at NERMA. This process we've developed at AAM is outlined here, and it really starts with the idea of trying to determine how much risk is appropriate. We do that starting with calculating a risk score, and we use that risk score and calibrate it versus the industry. Now, when I talk about calibrate, that kind of means intuitively, as you think about the risks you face as a pool, if you have a fair amount or elevated amount of underwriting risk, it probably is a good idea to have lower investment risk. And vice versa, if you don't have very much risk on the underwriting side, you probably can afford to take a little bit more investment risk. And that's this process of determining a risk profile, or how many dollars it would be appropriate to put at risk in a bad investment year. We take that, and then we can run an optimization and models to identify a strategic asset allocation. You verify it versus compliance, and review and revise, I think, explains it pretty well. Ideally, often this process ends up spawning conversations not just about a model, but about risk broadly. What we thought we'd do is maybe step through an example or a case study we did with an actual client. Now, just to be clear, this is neither NERMA's data nor PDERMA's data. That's kind of a mouthful to say all at once. But this is data from an actual risk pool client we went through this process with earlier this year. We've changed the numbers a bit. And what we show here is really how do we calculate that risk score, which starts that discussion of risk with our clients. The way we calculate it is we start with 4 kind of highly standardized measures of risk and volatility that are common throughout pooling and insurance in general: combined ratio, underwriting volatility, and then underwriting leverage and investment leverage. We've chosen those 4 metrics, because they are commonly used and commonly understood within the industry and within pooling, but also they tend to be, aside from investment return, which we'll get to, really key drivers of both risk and return to your surplus going forward. So we thought these would capture a lot of the risks that you're facing, or the return you're capturing for the pool. Below each of those, you'll see a graph with a diamond. That diamond represents this client's actual score. So their combined ratio over the last 3 years was actually 83.9. This is a work comp pool. That green to red graph is separated into quartiles, and that represents a broad industry average. We looked at 504 property and casualty companies along these same metrics. And what we're doing is measuring the risk, or in this case, the combined ratio of this client versus the industry. So combined ratio is solidly in the bottom quartile. That's very good. Underwriting volatility is a bit high. But then the leverage metrics, both underwriting and investment leverage, are low and well into the bottom quartile. And really the leverage metrics we see here, in my experience working with risk pools, often leverage metrics are low. Risk pools as an industry tend to have a lot of capital. What we do at AAM is we take those 4 metrics and we distill that down into one number that we call the AAM risk score. The reason we've distilled it into one number is that it really allows, in our opinion, for easy comparison as we calibrate versus the industry in general. So taking those 4 metrics, distilling them down into one number, this client's risk score is 14.3. As a portfolio manager, 14.3 doesn't mean as much to me as it does the fact that that orange diamond here for this client is well in the bottom quartile. So they're at a high level, the risk of their pool away from investment risk is pretty low. What that means to us is they can probably take more investment risk. So a low AAM risk score really translates into higher recommended investment risk, or higher than average recommended investment risk. Again, the way we're measuring investment risk is to talk about an investment stress loss, or this 1 in 200 event, relative to the amount of surplus you have. For this client, that ended up being 7.7% of surplus, or $8 million in a adverse investment scenario. Now, truthfully, if this was a commercial carrier, likely we would have recommended even more risk in their portfolio. But risk pools, as you both know, are unique. And you have unique uses of surplus that maybe in the commercial market you don't see competitors having. So you need to support your members, not just through underwriting and being there through cycles, but you have grant programs, risk management, things like that that support your members. Maybe Bob, do you have some thoughts on some of the programs PDERMA has in place that might be uses of capital that you'd want to make sure are protected as you think about taking risk?
I mean, yeah, we have a couple really significant loss prevention type programs. We have a couple full-time lawyers on staff to handle a lot of the EPL and legal questions that our members get as the government's constantly changing regulations and especially now during COVID restrictions and guidelines and how to handle that. So that's really valuable. We have a team of loss prevention consultants who visit the members, and like I said, we're covering an array of risk from swimming pools to restaurants to rock climbing walls to baseball fields and on down the ski hills and police departments. So there's a number of things that our members look to us to help provide those services, in addition to just being a stable pricing body. These are governmental entities that have tight budgets. Anyone reads the newspapers, they know, the kind of financial condition the state of Illinois is in, and our members are not going to get much help from, from the state in terms of tax revenue. So they're looking at us to do the best we can to keep rates, as stable as possible over time, and that requires the ability to have enough capital, available to say, hey, we can afford to charge less to our members this year, because if we lose money, we have the resources to back it up at this time, as well as things like this year, we were able to return some capital to members, knowing that they were going to have a difficult time with revenues and additional costs related to the pandemic, such as cleaning costs and items of that nature. So yeah, there's a lot of ancillary costs that go into running a pool that like you said, you wouldn't see on the commercial side. And you kind of got to remember that you're always managing their money. Whereas on a commercial carrier looking to maximize profit for shareholders, that's a lot different than holding someone else's money. And we want to make sure we're, good stewards of that money.
Andrew, anything to add on that? Those are some great considerations.
Great comments, and especially the part about being good stewards of their money. That's exactly it. We've expanded our loss prevention services over the last several years. When I started, we had one person in the loss prevention department, and he traveled the entire state and tried to just meet with members and discuss with them, the significant loss leaders that he saw and things they could do about that. Since then, we've expanded. We have someone that just specializes with road safety. We have someone that specializes with law enforcement. We have a we have a contract with an attorney who handles personnel related topics and phone calls. It's a helpline that she runs, and she's available anytime a member needs to call and ask a question to keep them out of pitfalls in that area. We have a grant program that helps. Bob talked about the budgets, governmental budgets, that they're very lean. We have a grant program that we started a few years ago that helps buy safety related equipment. So we ask the member to pay part of it, but we set aside funds every year to assist with making those purchases. Things like bulletproof vests and security systems, and maybe different road signs, or a retro reflectometer, I think is what it's called, that shows how reflective your road signs are. That's something that we purchased so that counties can check it out and borrow it, things like that they could never afford to do by themselves. So those are all, I think, very high impact things that help us to be good stewards of those dollars before we hopefully can return them in the form of dividends over the course of time back to the members.
Yeah, you both use the term good stewards, and I think that is a great summary for what everyone's trying to do here, right? And that's why, as we think about investment risk, I think it makes sense to start from a position of, for risk pools, relative conservatism, and we can always build extra risk in from there. But all of those services and support you're providing for your members are critical to who you are as a pool. And certainly we'd want to be really careful that we're not making investment decisions today and adding risk that would put those in jeopardy in the future. And so that kind of all goes into translating an AAM risk score to a recommended amount of investment risk. Like I said before, if this was a commercial carrier, given how low the risk score is, they likely could take on more investment risk than what we're showing here. But we do try and include all of those factors. So thanks for sharing that. So the last part of this is to identify the actual strategic asset allocation. So this risk pool's current allocations on the left side, and on the right, you'll see a modeled allocation. What we did is take this same 7.7% of investment risk, or $8 million, to put it in dollar terms, of downside, and then optimize a portfolio, in this case, to maximize return without exceeding the downside of $8 million. So we have the $8 million. In this case, the yield stays consistent, but expected return over time increases by 0.8% a year. Now, as we talk about projections, I think it's important to keep in mind, at AAM, we don't believe a model can be used to effectively project out what's going to happen next year or any short-term time frame. What we're looking at here are longer-term, over the course of cycles, projections, and it's really a long-term strategic asset allocation, not, again, using a model to make massive tweaks because we think the market's going to be up or down over the next 6 or 12 months. But for this particular client, again, over the long term, we'd expect to add about 0.8% return, given a little bit of extra risk that we're adding to the portfolio. Andrea, you alluded to this earlier. The other component of this is not just looking at investment risk, but really overall enterprise risk. So including not only what does a 1 in 200 bad investment year look like, but how does that compare and how does that add to a 1 in 200 bad underwriting year? So at the bottom here, we combine return on equity and kind of an average year, including both investments and underwriting, but also stress. If you have those really bad years that intersect with each other, what statistically speaking might one expect from downside? So in this case, this particular client is adding risk, including underwriting risk, 11% of surplus to 13.7% of surplus, a relatively modest change. In terms of the actual allocation, when we optimize these portfolios, naturally with a little bit more risk that we're willing to take, we've reduced investment grade bonds by about 10%. In this case, what we recommended was adding to high yield and bank loans, given their yield advantage relative to the investment grade bond market. In this case, we recommended maintaining an equity allocation, just shrinking it a bit. And we also introduced a new asset class, convertible securities. If you're not familiar with convertible securities, these are first and foremost bonds that are convertible into the underlying equity of the issuer at the holder's option. Given the somewhat hybrid nature of bond and stock characteristics in convertible securities, those tend to perform almost like equities, kind of equity-like returns over time with a little bit lower volatility, or lower volatility than equities. So those are often a good fit in an asset allocation process as well.
I've had, from different experiences in my life, it's kind of ironic. I've worked for 2 entities that could not have been more extreme. One was a commercial carrier founded by some hedge fund investors. So their only concern was investment return and didn't really care about risk and didn't really care that much about underwriting risk and leverage. They just wanted to get as many dollars in and invest as possible. And to try to take them through the process of, hey, we've got, we're too much at risk here, because you get so much of your covariance, where what happens if these 2 things happen at the same time, and they just didn't really want to think that way. And then I went to another entity that was the exact opposite. It was founded by a group of underwriters who were banking their ability to make money on the fact that they're great underwriters and didn't want to lose any of their capital to investment. So they were very, very conservative, and it was very difficult to explain to them that that's also really risky. Because once again, you can have things that happen at the same time. Let's say you have to sell off a large portion of your bond portfolio at the exact wrong time, and you're not, diversified enough. So to put it in these kind of context.
Thanks for that. What I've also found interesting, and I don't think I said it here, is you talk about this $8 million as an example of investment downside risk. I mean, often you're just talking about a temporary loss. Markets go up, they go down, but over time, particularly in the outside of the fixed income markets, over time, they tend to go up over time. In the fixed income market, you get your money back at the end. So these losses are temporary. And that when we talk to clients and boards about that part, as well as you have to have enough capital to withstand those temporary events, but this is not $8 million that you're going to lose forever. You just need to be able to ride through one of those 1 in 200 year events happen. You need to be able to have the capital to support that throughout.
And that's interesting, a similar process we went through in some of the risk modeling we've done. We looked at, what if we removed all of our equity investments? How does that change our overall risk portfolio? And it decreased the biggest drops in any one year, But over time, it required us to have more capital on hand because we have less opportunity to make money during the years when the markets are going up, right? So it's making sure you just have enough money to withstand that bad year. If it happens, like you said, you'll probably recover from it. But overall, you're going to generate, with a properly balanced portfolio, you're going to generate more investment income, which will require you then to have less capital to support your operations.
100%. That's a great way to think about it. All right, with that, we'll wrap it up. And just in summary, some of the things we've talked about today, there are a number of challenges facing risk pools, both on the reinsurance front, a succession planning, and also this low level of interest rates. We at AAM think low interest rates, or relatively low interest rates, are here for a while and will continue to pressure investment returns for some time. And like we've been talking about over the last several minutes, this is as good a time as any, given those pressures, to take another look at the asset allocation in the portfolio, make sure the risk tolerance, the risk budget is appropriate, and that you've allocated the portfolio to maximize your returns within an appropriate risk budget. And while you're going through that process, it is worthwhile, if you have other investment classes that asset classes that you're interested in, to include those in the models and see how they may or may not fit within your investment program. So with that, I'll wrap it up with some disclosures. I'll thank Bob and Andrea for taking some time out of their day to join me today and talk through these topics. And thanks everyone for listening.